Hello, it's ChewDog Charts. Now, the stock market has given investors some of the best performances over the past 9 years that you'll likely ever see in your lifetime. At times like these, the last things on many investors' minds is considering the risks in their current portfolio. Yet, those who failed to take measures to manage the risks following the massive bull market in the mid 2000s ended up regretting it in 2008 and 2009. However, no one's telling you that it makes sense to sell off your entire stock portfolio because you fear that a bear market might be coming. Rather, there's one simple way to manage your risk that involves much less dramatic moves. Yet, it still goes a long way toward ensuring that you'll get maximum benefit from the stock market's past performance as well as appropriate exposure to the market's future returns. Just rebalance your portfolio, and you'll be in a much better position whatever happens going forward. So today, we're going to talk about rebalancing your portfolio. And we'll also take a look at a few moves by Warren Buffett to rebalance his portfolio. All right, let's take a look. Rebalancing your portfolio refers to ensuring that the allocations of investment capital across your investments are in line with the target allocations that you've set in an overall investing strategy. For instance, if you've decided that you want to maintain a 50-50 split between, say, stocks and bonds, then rebalancing involves looking at the current mix of stocks and bonds and seeing where it is compared to that 50-50 target. If the value of your bonds is higher than the value of the stocks, then you'll sell some bonds to buy some stocks. If the stocks have gone up relative to the bonds, then you'll do the opposite, selling from the stock side of your portfolio to purchase some bonds. So rebalancing can be as simple or complicated as your investing strategy. Some investors have detailed target allocations, not just a broad asset class, but also to certain sectors of the stock market or even across certain individual stocks. So the more detailed your target asset allocation is, then the more complicated it is to rebalance. But it's also more important when you're committed to keeping the overall risk under control. Why rebalancing is so effective has to do with the way that most investors find success in their investing. You might think that the most important aspect that determines whether someone makes more or less money in their investing is which specific stocks they buy for their portfolios. That idea makes sense intuitively because the best known investors have developed an uncanny ability to find opportunities from particular companies that turn out to be among the best long term picks in the market. Yet, as it turns out, the most important element of investing success isn't necessarily stock picking. Rather, it's deciding how much money you allocate across broader investment asset classes such as stocks, bonds, real estate, or commodities. Individual investments can rise and fall haphazardly, but over time, well-diversified pools of similar assets produce steadier, more predictable returns. Moreover, mixing different asset classes can reduce risk while enhancing your returns. The best time to rebalance your portfolio is when markets are at extremes such as we are today. It's at these inflection points that you're most likely to capture the greatest benefits from rebalancing. For instance, right now, many investors will find that their portfolios are more heavily invested in stocks, perhaps more than is appropriate for their risk level. So selling stocks at these record highs is a much more attractive way of rebalancing your portfolio than waiting to sell after they've lost some ground, such as 2008 and 2009. So if you haven't already rebalanced your portfolio in a while, then you'll likely find that your risk levels have changed. Some risks have increased while others have maybe reduced. So taking time to rebalance your portfolio right now will help get your portfolio into a more comfortable risk level, and will help you avoid some of the disastrous results that we've seen in other market peaks, such as in 2000 and 2008 and 2009. Again, it's not necessary that you have to sell off your entire portfolio. Just figure out, have a plan of what your risks are and what you want in your portfolio, and then just take a look at it every so often and do some rebalancing. All right, well, let's now take a look at Warren Buffett and some of the moves that he has made recently. So one change that happened in Berkshire Hathaway's portfolio is that Wells Fargo Company has become the #1 holding. Now, as you can see here by the chart, it's had a relative decent move recently up to $61.55. And we can see here that it peaked earlier in mid-2015 and then came and consolidated into, say, late 2016, perhaps a result of a lot of the problems that Wells Fargo's been having in the last couple of years, if you've been paying attention to the news. So it did have a rebound into early 2017, one more consolidation into mid-late 2017, and it looks like we're getting a move off of the 50 EMA through the 20 EMA and now to a new high. So let's go down, take a look at the MACD. We can see that the MACD bottomed here in late 2016, moved up through, the fast line moved up through the trigger line, and came back down and then reflected off here most recently. So in my opinion, I think this is going to be moving upward, and it looks like it's going to be fairly strong. We're above the zero line here, and there's a little bit of acceleration or separation between the fast line and the slow line. We see that here in the histogram as well, the acceleration. Moving down to the momentum indicator, the same, shows the bottom here in 2016 and then the strong upward move. Also replicated by the price rate of change, bottom, strong move. Down to the relative strength. Not as strong as some of the other oscillators, but we do show the bottom here in early 2016 and then a test of that here in, say, mid-late 2016, and then the upward move. Into the stochastics, much the same as the others, the bottom here, and then a strong move. Here in volume, we see a slight increase at this level here, but for the most part, it's generally level. Down to the Williams, again, a bottom at this point in, say, mid-late 2016, and then off we go. Back up to the price chart. In my opinion, I'm not making any recommendations to buy or sell, but this looks like a good stock with a decent bounce off of the 50 EMA through the 20 EMA, and I think that there's a lot more ahead for Wells Fargo. So let's take a look at our next stock. The next stock we're going to talk about is Bank of America, another banking stock. And if you remember, Warren Buffett invested about $5 billion in Bank of America during the debt crisis. And as part of that deal, he received warrants to buy 700 million shares of Bank of America stock for $7.14. And Buffett had said that if Bank of America's dividend was raised to a point where Berkshire could generate more income by owning the common stock, then he would trigger those warrants. He'd exercise them. And he did that. So now he owns another 700 million shares of common stock, making Bank of America one of his top 10 holdings. Now, I don't like Bank of America as much as I like Wells Fargo, but still, it looks like a pretty good stock. It had its peak back here in, say, late 2006, but its move here looks like it's going to try to head in that direction. Moving down here into the MACD, we see the very deep bottom in 2009. The move up here, and then a little bit of consolidation down here in, say, mid-2016. But since then, it's been up and away. A little bit of a reflection at this point in time here, and perhaps some acceleration that you can see here also in the histogram. A little bit of acceleration there. The momentum indicator is not all that strong, but it is above zero, and so it's okay. The price rate of change, in my mind, is probably one of the better indicators that I see for Bank of America. A strong consolidation here, and then the upward move well above the zero line. Relative strength shows the bottom here, and then a good strong move upward. As well, the stochastic, somewhat of the same, a bottom here, and then a good strong move upward. Into the volume looks fine, nothing significant one way or the other. And then the Williams also a bottom here in 2016, early 2016, with a strong move. Back up to the top, we see that the price did enter a little bit of a consolidation period here, but it's been up and away ever since then. So I like Bank of America. I'm not making a recommendation to buy or sell, but it is a stock that I like, and it's been interesting to watch that throughout the history of Buffett's holdings since the crisis in 2008, 2009, and then, of course, triggering those warrants. Let's go to the next stock. And so the next and last stock we're going to talk about today is IBM. And this is one of the major positions that Buffett has sold off in rebalancing. In replacement of IBM, Buffett bought significant positions or additional positions in Apple. Now, the sell-off in IBM, basically, Buffett was saying that there's just a lot more competition in IBM's industry, and then the competition is going to become much more intense. Now, far be it for me to tell Warren Buffett what to do, but I think he might regret the decision to sell off International Business Machines, as I'll show you here. Now, we did top here in, say, early 2000, and we've had a couple, 3 years of difficulties with IBM, but it did bounce off its 200 EMA, and it's wrestling with the 50 and the 20 EMA, moving down below here, and then just recently starting to move up. But let's go ahead and take a look further here. And into the MACD, I think we see the bottom here in early 2016 with the rise. The fast line has crossed back through the trigger line, but it's approaching the trigger line one more time here, and I have a sense that it's going to move through. We'll have to wait and see on that. The histogram shows much of the same. The momentum indicator also shows, say, the bottom in mid 2015, and then that top here in early 2017 with the move back down here. But I think it's starting to set up another bottom here, and to me, that would be if it does set up a bottom, that would be a successful test here of this bottom here, showing then a higher low. And I kind of see that as well here in the price rate of change, though we do have a small reflection back here, but I just don't think that's going to be real strong because the downward move both in the price and the oscillators isn't really all that strong. So I think that's going to turn and then head up, but we'll see in the next couple of months or so. Relative strength shows the bottom here. To me, that is a successful test of this bottom here. So again, another reason I think things are going to be changing. Stochastic looks like we potentially may have another bottom here, which would be again a successful retest, a higher low. Volume looks fine, moving sideways with nothing significant one way or the other. And then the Williams. Williams does show some of the weakness with another bottom here in, say, mid 2017 with the upward move. We'll have to wait to see what this does here. Moving back on up into the price chart. I think that this, to me, again, is telling me that we've had this bottom here, and I think this is going to turn out to be a successful test of that bottom. And then I think we're going to move back up through the 20 and the 50 EMA. We'll have to see. That's just my prognostication, but I will be right or wrong here in the next few months or so. So let's keep an eye on that. All right, again, for today is ChewDog Charts. I'd like to thank you for joining me. Please subscribe and then hit that bell for notification of any new videos.